Very interesting conversation coming up with Pankaj Tibrewal, founder and CIO of Ikigai Asset Manager. Pankaj, thank you so much for speaking with us. I was just going through your post, which has gone viral. I wonder if we can get it up on screen, where you've talked about what all 100 baggers have in common. And while we get those graphics up, I'm going to start with point number one. They start small in very big markets, small fish in a large pond, and you've given the example of Bajaj Finance. Are you seeing any such 100 baggers right now?
Thank you. Thank you for having me on the show. See, the idea of writing this post was that today the sentiment is extremely fragile. There's a lot of news flows, headlines, geopolitical issues, but that should not take away our focus that over a period of time in the last 25 years, we have seen much worse of the news and much worse of events play out. Still, we have seen market creating a lot of multi-baggers over a period of time, and hence bottom-up approach should be not forgotten during these times. The first point which you mentioned was small small fish in a large pond. Is that the runway for growth for any of these companies which became 100x over a 20-25 year period was that the tailwind of the sector was always there in terms of growth and runway for growth. And hence we gave this example, which is apt for India, that when Bajaj Finance in 2008-9, if you go back, they were just 0.2, 0.3% of the total credit market in India. And hence you had a long runway for growth. Still, after compounding so fast, they are still at just 2.3% of the market share in terms of total credit market in India. So the idea was that whenever you look at any company, if it is a small TAM, then they will be fighting to gain market share in that small TAM. But if it's the opportunity is very large enough, then they will get opportunity to grow without fighting, and then they can look inwards and try and see how they can take market share away from a medium to long term perspective. So that's the first point which we have seen common in all the multi-baggers in India or global, that the TAM was quite large, the opportunity size was very large, and slowly and gradually these companies compounded and took away market share in the large TAM. So that was one. As your point, can we see it today? Answer will be on the hindsight, definitely yes. The best part was that all these multi-baggers, you never saw it the 100x coming in. As they kept on executing, I think you knew that they are on the right path. If I say that today I know for sure which are 100x, I would be lying. Because nobody knows at the start which is going to become 100x. You just gradually observe them over a medium to long term, and that's how the multi-baggers kind of create. And the power of compounding is so huge. I mentioned it that 20% growth in any year doesn't look that exciting, but if it is done over a 25-year period, it becomes 100x. So that's the power of compounding over longer periods of time.
No. So, Pankaj, to rephrase, I don't expect anyone to know today what is going to be 100x. If they did, and if they claim they do, they probably are not telling the truth. What I meant to say is that, things are looking a little bleak right now. And then the worry is, are we in an overvalued space? Are we tapped out? Is there enough discoverability there? So, okay, let me minimize those expectations. Not 100x, but future winners. Do you think there are enough and more right now in the Indian market which are still undiscovered?
Absolutely. I believe that from different sectors it would come. You look at the non-lending piece in the last 5 years with the market growth coming in. The non-lending capital market piece has done so well, whether it be exchanges, depository, AMCs, all have had their own share of growth over the last 5 years. And I think this is one segment one should be keeping an eye on, apart from lending. Then the second space is the entire consumption basket, where you are seeing the discretionary spends taking over the staples. And we believe that wherever there is aspiration at the right value, that segment will create huge value as you move ahead on the per capita GDP side. The third segment is chemicals. We are a tiny part in the global chemical industry, which is almost $1 trillion plus industry. And slowly and gradually, China is vacating the lower end of manufacturing. And India has that chemistry and skill sets to go up the value add ladder. So I think chemicals is another. Look at the auto ancillary and the precision engineering part. I think it's a very large opportunity in terms of defense, aerospace, semiconductor part that will create huge values and winners over a period of time. So it will come from cross section of industries. In AI, for example, you will need companies in the mid tier and the lower tier to implement it. So you will see over the next 5, 10 years winners emerging from the IT space, and this is a very interesting space that every decade has created new winners. So last decade you saw Coforge, Persistent, and all those winners getting created at the expense of large caps. So probably next 5, 10 years you will see more such new names getting emerged, or maybe the mid-tier names getting into large cap names over a period of time. So I'm very positive on a bottom-up opportunity in India. And slowly, as you go down the market cap curve, the analyst coverage on those stocks starts to drop. And that's where you can do a lot of scuttlebutt, add value, in terms of what can happen over a period. And once market caps becomes larger, the analyst community starts to cover. So there is a discovery phase which can happen between 5,000 crore market cap to 25,000 crore market cap. And I think that's a very sweet spot many companies are sitting on right now in India.
Very interesting. Pankaj, good morning. Neeraj here. Um, we have some corporate conversations coming up, so I may not have as much time as I usually would like with you, but I'm tempted to ask you this one question. I saw your newsletter, and in the a few days ago, and in that newsletter, you've mentioned that silently there is this capex happening both on the private side and the corporate side. Most sell-side notes that we see lament the fact that capex is not happening and they're not constructive on capex plays. Your note seems to imply that you are not in the same camp. So are we to understand that you are constructive capex beneficiaries for 2026, or am I reading it wrong?
So Neeraj, you are absolutely right. When you look at the data points compared to the narratives which is currently prevailing, is that private capex is on a hold, it's slow. But the data suggests otherwise. The trailing 12-month private sector capex, private and government sector capex is at about 11.5 lakh crores. Don't forget this number a few years back used to be in the range of 5 to 6 lakh crores. So slowly and gradually we have inched up to 11.5 lakh. And when you combine it with the state and the government capex, the number is at 31 lakh crore plus. So the point which we were trying to say is that capex has started at the margin, and it's not as bad as what people are making out to be. The only thing we need to be worried about is that the capex today is very loop-sided, done by few groups. And hence, you need a broader breadth of companies and sectors to start participating in it. And once that start happening, I think the private sector capex should be the next driver of growth in India. And hence, we wanted to bring that point that all is not lost. What people are saying is that capex is extremely slow, is not absolutely 100% true. The trailing 12 months suggest that we have inched up to 11.5 lakh crores on private sector capex.
Wow. Okay. So that is one. The other, Pankaj, is is this whole set of pockets which have come under a, I mean, I don't know whether it's temporary or permanent, but I'm calling it temporary, a temporary cloud, which is this whole energy transition space or the power sector, right? The darling of better part of 2024 and better part of 2025 as well. The last 6-7 months, be it wind energy, be it thermal, be it ancillaries, all of them have lost ground, lost valuation multiples. Now, do you foresee, because the government intent is there, that there will be a prolonged capex and growth cycle for these names, and at some point of time, they might rediscover the mojo because of cash flows, because of subsidies, because of this whole energy transition bucket? And are you constructive power and ancillaries?
So Neeraj, I think we had extended this narrative and theme too far in my view, in terms of the valuation which we were ascribing to most of the companies in this sector. I think market is mean reverting those valuations, and hence we are seeing the pain. You had companies trading at 100p, 150p, which probably was not correct in my view. Still, after correction, the valuations which are there on the headline basis seems to be on the higher side. I'm not disputing that the energy transition is real. World is going through that. And now we have more power coming from wind and solar than coal across the world now, right? Electricity. So I think that is a real thing which is happening. But in India, don't forget that a large part of the value chain and the ecosystem, we have been just dependent on import. We don't have a fab unit. We don't have a big, large ecosystem for cell manufacturing. A large part of capacities and stocks which were coming in were from the module manufacturers, which is nothing but more of an assembly job. And market was very charitable in giving very high valuations to them. I believe that this probably will take some time and unwinding itself. In the power overall, we are positive. I think India has seen lower power growth last year, and that weighed on most of the power utilities as we speak. I think that has started to change. Probably this will change this year. December was the first month where we saw 6% power demand growth. And if that starts to happen, a lot of utilities on the private and public sector, plus the transmission part, I think is looking very attractive post the correction. So we are very selective in our thought on the power sector. But from a medium term perspective, we are positive. Also, we don't forget that a lot of pump companies, a lot of these solar module companies didn't generate cash flows. The operating cash flow for 5 years in a row have been negative. And people justify that growth is coming, so cash flows are not important. But don't forget, growth without cash flows can be toxic and can destroy value.
Pankaj, we're looking forward to an important period right now, and the budget, among other things, would be the next driver for markets as well. I know this is a government that looks at reform outside the budget as well, but what are you hoping to hear and see from an India perspective, from an economy perspective, from the budget?
So I think nothing wrong done on taxes, I think will be a good news for overall markets. I think one thing which government needs to really think about is the buyback tax. Today, buyback has become virtually non-existent. We believe that there's a large amount of capital which is stuck, which is not either going for capex or not getting returned back to the shareholders. It's sitting in funds, small liquid funds or bank deposits or whatever, and that multiplier impact is not getting created. So I think buyback tax, which the companies use to distribute the excess cash, I think she should be reviewed. It's a large amount. If you look at all the IT companies and cash-rich companies, either they can deploy that back into their business at or the capex, or they can distribute. I think that is not happening. That one thing one should be looking forward, and something to spur the momentum back into the private sector in terms of capex side. I think these are the two important drivers. Government did a lot last year in terms of consumption. You saw the tax rate cuts in the last budget, followed by GST rate cuts. So I think government has trying to revive that consumption basket alongside, I think, manufacturing, because don't forget that the government capex will not rise at the same pace which we saw in the 4 years post-COVID at 33% CAGR. I think last year we saw it's just increasing by 8-10%, and probably that would be the path going forward in the next 2 years. So I think private sector needs to be really pulled up in terms of capex visibility for the next few years for the economy to sustain the growth momentum. So these are the few things I would look forward for.
Pankaj, how will that really happen? I mean, in terms of government spends, at least, the space has shrunk after what they did with income tax and then with GST.
Yes, so I think there are 2-3 avenues. I think a large part of disinvestment is one thing which we have missed for the last 5 years in a row. Every year we come up with a number. This year was a smaller number, but still we are running or trailing behind that number. So that is one area where we can get substantial amount of revenues in terms of disinvestment. The second part is the RBI dividend. I think that number could be a decent number this year as well. And the third part is that once the nominal GDP growth starts to inch up, the top line growth of corporate India also inches up, which means higher and better tax collection. So India needs some kind of inflation, which probably we have not seen for a long time at the producer level. I think with commodity prices going up, that should also be okay. But this year, as a house, we are looking at about 2 to 2.5 lakh crores of revenue shortfall, which should be bridged by higher dividends, maybe some tinkering on excise duty from the OMC side, and disinvestment if it can be hurried up for the next 2 months, and higher dividend from RBI. So that's the shortfall bridge which is there right now, about 2.5 lakh crores, which can be bridged by the government in the near term. But from a medium term perspective, I think finally it's growth which has to lead to higher tax collections.
Okay. Pankaj, one last question very quickly, and which is, if the money is rotating out of developed markets and US markets into emerging markets and India has underperformed, could 2026 be the year of outperformance? And are there themes to play that? 60 seconds odd, Pankaj, if you can.
I think, Neeraj, my belief is that India can surprise this year. Everybody is negative. And I always believe market is a Triveni Sangam of three things: fundamental, flows, and sentiment. Today, fundamentals, incremental basis on the macro side has been much, much better than what we were at the start of the last year. So I am quite hopeful, and earnings growth picking up in terms of FY27 being double digit compared to FY26. I think that's a fundamental, incremental, better change. Sentiment is crushed today. You speak to anybody, everybody is negative. I think it's a contrarian signal. And probably, in my view, if turn of events happens with a trade deal with US or something settlement on the geopolitics, I think that sentiment can turn around faster. Flows, we have seen the worst in terms of $19 billion being outflow. I think this year, if AI trade gets some picked out, I think, and I'm a little negative on the AI trade globally. I think India can find flows back into it. And FDI, which has been net FDI, which was very bad last year, $80 billion of gross FDI, less than $1 billion of net FDI. I think incrementally that would also change, supporting rupee and balance of payment. So incrementally, I think fundamental on our side, domestic flows is okay. FIs can revert back. And third, sentiment, I think, is crushed down today. Incrementally, if that changes, I think the Triveni Sangam starts to make a lot of sense. And in that way, India should outperform the other emerging markets. That's our hope. Let's see.
Cross fingers for that. Pankaj, thank you so much for joining and giving us that perspective. And lovely talking to Pankaj Tibrewal.